Okay, let's talk about one of the biggest, oldest debates in the world of money. What's the better way to build wealth? Is it buying actual property, something you can see and touch, or is it putting your money into the stock market and just letting it grow? Well, today we're going to settle it by running the actual numbers. So who's the smarter investor here? To figure this out, we're going to follow a story. The story of two identical investors who go on a 20-year journey to build their fortune. And I'm telling you, the winner, well, it's probably not who you think it is. All right, let's meet our two contenders. On the left, we have Jake. He's taking his life savings and becoming a landlord. On the right, we have Marcus. He's taking his life savings and becoming a stock market investor. They're starting at the exact same point, but they make one single crucial choice that changes everything. And look at this. The starting line is perfectly even. Same savings, same salary. Jake takes his 50 grand and puts it down on a $250,000 house. Marcus takes his 50 grand and puts it all into an index fund, and boom, the race is on. You know, right out of the gate, you can see how different this feels. Jake has a physical house, keys in his hand. He's a great story to tell at parties. Marcus? He's got a confirmation email. Let's be honest. In terms of bragging rights, Jake is winning big time. So for the first few years, you can just imagine, right? Jake is feeling like an absolute genius. He's collecting rent checks, he's building equity. He gets to drive by this house every day and think to himself, wow, I own that. His investment feels real and it feels smart. So let's fast forward 3 years. Jake does some quick math on the back of a napkin. He adds up the rent he's collected, subtracts the mortgage payments, and on paper, it looks like he's made almost $17,000. I mean, fantastic, right? Seems like a clear win for real estate. But we all know life isn't lived on a napkin. That number looks great, but what happens when reality kicks in? What's the real number? Oh yeah, here comes the fun part. These are the costs that never make it into the success story. Property taxes, insurance, the water heater that decides to break on a holiday weekend, the leaky roof, the list goes on. And notice that last one, his own time? That's a cost you can't even put a number on. And wow, just look at that difference. That impressive $17,000 figure he was so proud of, it just evaporates. Once you factor in all the real-world costs, it shrinks all the way down to just $3 grand. That is a massive, massive reality check. So let's do a quick check-in. 3 years of work, stress, and late-night calls about leaky faucets, and Jake has pocketed maybe a few $1,000s. Meanwhile, Marcus, who has done literally nothing but chill, his portfolio has quietly grown to be worth around $76,000. So how on earth did Marcus pull that off with zero effort? Well, it comes down to one of the most powerful forces in the universe, compounding. It's like a magic engine. Your money makes money, and then that money starts making its own money. It's like a snowball rolling downhill. It starts small, but eventually it becomes this unstoppable force. Okay, so let's zoom out to the 10-year mark. We can see some key milestones here. Jake has to deal with big, painful expenses, like a whole new roof. Marcus's portfolio just keeps chugging along. But here's where things get really, really interesting. By year 10, they're actually in a very similar spot. Now, this slide is everything. Seriously, look at the top line. Their net worth is basically a tie. But then, look at the cost to get there. Jake has put in hundreds of hours of work. Marcus, zero. Jake took on $200,000 in debt. Marcus, zero. And the risk? Jake is all in on one house in one neighborhood, while Marcus is spread across thousands of companies. This is where the story stops being just about money. So let's jump to the finish line. 20 years have gone by. We're talking market crashes, tenant issues, major repairs, the whole shebang. What's the final verdict? Well, would you look at that? After all of that, they end up in almost the exact same place financially. And that right there is the real lesson. The final number on the screen isn't the point, it's the journey. The lifestyle, the headaches, the peace of mind, how they got to that number is the entire story. It all boils down to the trade-offs. What kind of stress do you want? Jake's path was hands-on. It involved work, debt, and having all his eggs in one basket. Marcus's path was hands-off, but it demanded the emotional strength to not panic and sell every time the market dipped. And let's be totally fair, real estate has some incredible advantages. Leverage is basically a financial superpower. Using 50 grand of your money to control a $250,000 asset is amazing. You also get potential cash flow every month, some sweet tax breaks, and you're in total control.
But then you look at index funds, and their biggest advantage is just how beautifully simple it all is. You can literally set it and forget it. Compounding does all the heavy lifting for you. You're diversified from day one. And if you need your money, you can have cash in the bank in a couple of days.
So what's the big takeaway from all this? The danger isn't picking real estate when you should have picked stocks, or the other way around. The real trap is jumping into either one without truly understanding what you're signing up for. The total cost in dollars, yes, but also in your time and in your stress. So as you think about your own financial journey, the next time someone tells you that one way is guaranteed to be better, I want you to ask them, and more importantly, ask yourself this one simple question. Because at the end of the day, the only answer that really matters is the one that includes everything.